So let's begin the next standard, that is SA 540, auditing accounting estimates, including fair value accounting estimates and related disclosures. And this is one of the toughest standard that we have. Like in entire CA final, if you recollect, generally these standards you feel tough. One is 402, 3402 combination and 540, and we have SQC 220. These are the 5 standards, or mainly 4 standards, which generally many don't understand. 240 is lengthy. 240 is slight complexity, not so tough. 250. 240, 250, 260 are medium. They're not really tough. But this is one standard where the entire structure of the standard, if you don't understand, you will never, you will not connect to it. You feel like reading the same again and again. Without understanding, if you're reading, you feel like reading what the same content again and again. So we'll discuss all those confusions, we'll try to clear. So auditing accounting estimates. Look, what are we doing? We are verifying accounting estimates. Auditing means what? Verifying. Verifying accounting estimates, including fair value accounting estimates and related disclosures. We are verifying all these 3. We are verifying accounting estimates, we are verifying fair value accounting estimates, and we are even verifying disclosures. You see, the objective of the standard, is very quite simple. Whether accounting estimates are reasonable and the disclosures are adequate. Only these 2. Whether accounting estimates chosen by the management are the reasonable. Means like generally when an accounting estimate is chosen, this estimate is generally based upon some methods. For example, this best example you take, environmental liabilities. To understand the total gross impact of the standard, this is best example. How to assess liability for environmental liability. How to assess environmental liabilities. How to assess environmental liabilities. For example, you have an accounting standard, PPE, regarding site restoration and decommissioning expenses. Somewhere after 15-20 years, maybe I have to close my factory and I have to change the place. At the time, I have to incur certain restoration cost, site restoration cost. I think parallel you have an income tax also, there is a deduction, 33 ABA. There is a deduction. The site restoration expenditure and even decommissioning expenditure. Like you have to decommission the entire plant and machinery and restore the entire site into its normal, nature, original nature, and you have to hand over back to the government which allotted to you. For that, you will incur certain expenditure. Okay, and that expenditure is surely generally so material. The expenditure is generally considered to be very material. The site restoration expenditure is material. That you have to incur after 20 years. Now, like how accounting standard says that expenditure, bring it to the present value. Bring it to the present value and add it to the fixed asset cost, as to the property, plant and equipment cost, and depreciate on the revised cost, correct? And we all know that every year this estimation will change, correct? The decommission expenditure related estimate, by the way, this decommissioning is an estimate only, right? After 20 years, I am going to incur some amount. Is this an estimate or not, first of all? Obviously, yes. This estimate is based upon so many factors. For example, right now if we do decommissioning, right now if we do site restoration, with the available technology, available vendors, available whatever the equipment available, we know how much we incur today. But we don't know how much we incur after 20 years. How much we are going to incur after 20 years, first you need to calculate future value. How much we are going to incur after 20 years, you need to take into account inflation rate, you need to take into account certain other factors, all that, changes in market conditions, all that you have to take into account, and then estimate how much future value you are going to spend and discount it at the opportunity cost that is available for you, discounted rate, correct? Future value is based upon the market conditions. Discounting is based upon the discounting factor. Getting it? And you bring it and then account it. Is this a significant estimate or not? Suppose a factory construction cost, the construction cost itself is somewhere around 25,000 crore. Let us assume the plant and machinery, that entire factory construction cost is somewhere around 25,000 crore. As on today, if you apply decommissioning, the cost of decommissioning site restoration will be somewhere 15 to 20% of the entire establishment cost. Somewhere it will be 3,000 to 4,000, 5,000 crores it will be. Considering inflation rate, future value, bringing it to present value, all that, it takes almost somewhere around some 3,000, 4,000, 5,000 crore will be the amount, correct? Some 3,000, 4,000, 5,000 crore will be the amount. This is a significant estimate. Here, this is a situation of high estimation uncertainty. This is a situation of high estimation uncertainty. When we can use the term accounting estimate? When we cannot figure out what is the actual amount, we take an approximation because precise means of measurement is not available. Correct? That's what the definition of accounting estimate. An accounting estimate is nothing but an approximation of monetary amount in absence of precise means of measurement. Because I cannot measure it precisely, I am only taking an approximation. Now tell me, every estimate, whether it is a normal estimate or fair value estimate or high certain estimate or low certain estimate, some uncertainty is there, right? Definitely uncertainty will be there. Some sort of uncertainty will be there for an accounting estimate. But there will be some estimates where the uncertainty degree is extremely high. The degree of uncertainty is extremely high. For example, how much warranty claims related expenditure a company can incur in the next year. A company can easily estimate approximately closure amount because based upon the past experience, based upon the industry data, we can assess it. But how much decommissioning liability the company exactly going to discharge after 20 years? Company is estimated, but the actual amount will be significantly different from the whatever the estimate. This is here, whereas in warranty, the estimation uncertainty is low, whereas in decommissioning liability, estimation uncertainty is high. So in 540, what the standard is asking us technically, check whether the estimates are reasonable or not. How do I check whether estimates are reasonable? First of all, whose primary responsibility to choose them? Board of directors, nothing but management. Whoever responsible party is there to prepare financials, they are responsible. So first I will look into what process entity has established. What process entity has established to identify areas requiring estimates. How the entity identifies accounting estimates. Then I will look into how they are making estimates. First I will look into their risk assessment process. Primarily risk assessment more than us, the management will be doing. So first I will ask entity, how are they doing risk assessment related to accounting estimates? Like how are they identifying areas of accounting estimates? Where and all in a company, an accounting estimate is required. Most of the times, the financial reporting framework itself gives clarification on that. The accounting standard itself tells you, that accounting standard itself gives you a list of items that require an accounting estimate. You just read each and every standard, it will have some reference to estimate, most of the standards. So you follow financial reporting framework, you can understand what are the areas that require estimates. Terms and conditions of various contracts. Terms and conditions of various contracts. Type of products they are selling. Events and transactions and conditions that are happening. All these will give a rise. All these items will give a requirement for the entity to create an accounting estimate, to recognize an accounting estimate, correct? And not only recognizing, sometimes entity might have to revise. Not only recognizing the estimate at initial level, they may also have to be revised. Accounting estimates requires revision in certain circumstances. Accounting estimates requires revision in certain circumstances. That also we'll see. That also we are going to learn. So first look at how the entity is identifying circumstances that requires accounting estimates, or look at the entity's risk assessment process, whether they are identifying changes in circumstances that require revision in the already estimated amounts. So what system the entity has implemented, what policies entity has implemented, first we need to look into it. Okay, we saw how management established internal control system for accounting estimates. We saw one of the internal audit department was given the duty, not internal audit, one of the finance department was given the duty. Internal audit is also monitoring that aspect also, which means there is a formal assessment process for accounting estimate. 2. Then what should I look into? How are they making these estimates? The second question that I should look into is what? How are they making this estimate? How people make estimate generally? Accounting standard will give you, for example, India 16 talks about how to recognize decommissioning liability. The method, the processes, the model is they're described, yes or no? So how they are making it? Sometimes they may use the help of an expert, they use some data, they use some assumptions. By taking all this into account, they make an estimate. Once accounting estimate is made, they recognize it in books of accounts. Once an accounting estimate is made, then they recognize it in books of accounts. So look at how they are recognizing, recognition and measurement, all that you see. How are they recognizing, how are they measuring in the books of accounts, all that. You need to perform substantive procedures now. Verify what workings are used, what methods are used. You need to test them. You need to perform audit procedures now. Then finally conclude whether there is an estimation uncertainty involved. Obviously estimation uncertainty will be involved. If at all estimation uncertainty is very high, that we generally call it as what? Significant risk. That we generally call it as significant risk. If at all estimation uncertainty is extremely high, whereas significant risk is involved, ask a company what they did to address this. What they're doing to address this. Suppose if estimation uncertainty company did not address, management did not look into it, they didn't consider about this, they ignored about it, they just did India 16 method, whatever followed, they just blindly did that. They didn't consider estimation uncertainty. You know what? When estimation uncertainty is there, you need to do a sensitivity analysis. The auditor has to, the management has to perform what? Sensitivity analysis when there is a high estimation uncertainty. What is a sensitivity analysis? Like present situation of present value of future expected decommissioning liability. That the future estimated decommissioning liability, we calculated based on certain assumptions, right? And these assumptions, will it be constant? Whatever the attributes, inflation rate, market terms and conditions, will they be constant throughout the 20 years? No. So what if one inflation rate changes? What if market terms changes? What if new advancement in technology comes and that became costly, decommissioning? Moreover, because of changes in climate conditions, all that, regulatory laws are becoming more and more vigilant, more and more severe. They are levying more and more penalties. So what are the side effects of all this? Management has to do a sensitivity analysis, like the decommissioning liability, one value they figured out, but that value alone will not be there. There is a possibility, if at all change in assumption, change in inflation rate there, then the amount will vary. If the inflation rate changes, the amount will vary. That why? And you need to check whether company has considered alternative assumptions. Indirectly, what you need to verify? You need to verify whether company has considered alternative assumptions or not. This alternative assumptions is nothing but what? Changes in one of the factor that changes the estimated amount. The one of the factor is inflation. Suppose one of the decommissioning liability we calculated 3,000 crores keeping in mind inflation rate of 3%. What if inflation rate is 7%? Then how it could be the liability? How? 3,800 crore revised liability. Suppose if inflation is 0, then the liability will be reducing to 5. If at all inflation is 12%, the liability will go up to 4,500, 5,000 crore. Like this, did the company did a sensitivity analysis? If so, why they did not consider alternative assumptions? Why they capitalized only 3,000 crore? Why not 4,000? Why not 2,000? Why the capitalized 3000? On what basis you concluded 3000 is reasonable? You should verify that. This verification, sensitivity analysis and all is required when accounting estimate involves high estimation uncertainty. Suppose if company did not do that analysis, what you have to do? You should develop an accounting estimate. In fact, you can't develop an estimate just like that. You need to develop a range. You need to develop a range. Like lower limit, upper limit will be there. You need to develop a range. Auditor has to develop. And that range is called as auditor's range or auditor's point estimate. What is it called as? Auditor's range or auditor's point estimate. So you should develop that. And with that estimate that you developed, verify whether the management's estimate is right or not. That is how the standard recommends, the standard mandates, the standard requires the auditor to verify estimation uncertainty. Once you verified estimation uncertainty, all that, once you verified how the accounting estimate is recognized, all that, you will get an idea, whether whether this accounting estimate is proper or not, whether this accounting estimate is reasonable or not, you will get an idea. Once you understood the accounting estimate is reasonable, then you will conclude, you will document everything and you will give conclusion. You will give conclusion whether it is estimate is reasonable or not reasonable. You will give a conclusion. That's it. With this, the standard is over. Entire 540. So we'll see each and every sub element of the standard and then we'll continue. Just a minute. So let's look into the sub elements of the standard. What is an accounting estimate? It's an approximation of monetary amount in the absence of precise means of measurement. I know in estimates, generally in accounting estimates, there is a possibility of management bias. Like management might choose accounting estimates unfavorable to them, which is one of the major fraud risk factor in terms of opportunities that is available to them. And for every accounting estimates, there will be an estimation uncertainty. Because of uncertainty in the estimate is there, we call it as estimate first of all. The possibility, susceptibility means nothing but possibility. The possibility of an estimate to an inherent lack of precision. What is an outcome of an accounting estimate? Whatever the estimate, suppose I have taken useful life of the asset is the estimate. What is the outcome of that estimate? Depreciation is the estimate. Depreciation is the estimate. Now, what is the auditor's responsibility? First, auditor has to do risk assessment procedure. Then he should understand how management is identifying the need for estimate. Then he will understand how management makes the estimate. Then he will has to verify estimation uncertainty. Then he will see how the management is recognizing and measuring it. Then we will obtain finally reasonableness of the estimate and will come back to reporting. This is the structure of the standard. Getting it? Now, so look at how what is the risk assessment procedure related to this one, or else direct, obtaining and understanding. This is important point. Inside this, the C point is very important. So what auditor has to do? The auditor risk assessment procedure. Why? See, auditor will do risk assessment procedure. What risk assessment? He will also try to identify where and all accounting estimates are required. Where and all accounting estimates are required, auditor also will try to identify. And he will then see what management did. That is what exactly risk assessment means. So first he will see what management is doing, and he will also try to identify what are all the areas where accounting estimates requirement is there. Then he will inquire the management. He will inquire the management. Are there any changes in circumstances? Are there any changes in circumstances? It may be in the business circumstance, it may be in the reporting circumstance, it may be regulatory circumstances, whatever. Are there any changes in circumstances in the business, in the regulatory or in the environment? Are there any changes? Why? Changes in circumstances may lead to revision in accounting estimate. Not only this, these are the, because of the, these are the circumstances that indicate, yes, there is a requirement for an estimate. Like changes in circumstances means what? Whether entity has engaged into new type of transactions. Suppose company has launched a new product. Till date the company is not dealing with that product. For the first time the company has launched electric cars. Till date they are not using, they're only using like internal ICU engines, IC engines, getting like combustion engines, getting it. So till date they are using only the fuel based engines. Now the company first time launched electric cars. How much provision should be created on electric cars? Should it be the same provision for warranty claims, just like how my normal fuel based engines, how much I create provision? Should I go with the same norm? Definitely not. The new type of product is launched by the company, which means estimate making process for these products must be different. Correct? Whether terms of transactions have been entered into by the company changed. Generally for all the normal cars which the company manufacture, they give 2 years warranty or 1 lakh kilometers, whichever is earlier. That's a standard warranty. But for electric cars, company is giving 8-year warranty, 1.5 lakh kilometers, whichever is earlier. They are giving what? 1.6 lakh kilometers or 8 years, whichever is earlier. And for the battery, whatever is there, further they are giving 12 years warranty. So terms of contract have been changed, terms and conditions have been changed. Obviously, the warranty provision related calculations, all that will drastically affect. Whether accounting policy related to estimates have been changed. Maybe for fuel based cars, I use some different accounting policies for calculating, whereas for electric cars, there are some well accepted, generally accepted accounting policies that are there exclusively for electric cars. How to account electric car sales related thing, especially provision related thing, how to account, there are some international gap data is available. The company is following that. Regulatory or changes outside the control. Since a company is manufacturing electric cars, the company is liable to create provision for taking back the car after the expiry. In the sense, after the car life is over, this company who manufactured, they only have to decommission it. They only have to dismantle it. You're getting it? They only have to treat that waste. Regulator has made a condition on every company manufacturing electric cars. It is not the consumer who is responsible to dispose that electric car. It is your responsibility to dispose the car after the useful life of the electric car. So regulatory changes are there, or new conditions or events are identified. Some new conditions or events are identified that requires an accounting estimate. For example, cars are, electric cars are suddenly being stopped. So many consumers are complaining of non-reliability, or so many consumers resale is high. Like these are all various factors that results in either creation of a new estimate or revision of an existing estimate. Understood? A wonderful example it came. In the class also I didn't give this example, but in class the different example I give. Suddenly it strikes, electric car example suddenly I give. Next, suppose if at all management failed to identify an estimate. Suppose if management failed. See here, what are we checking in this point? We are identifying how the entity identifies estimates. How the entity identifies estimates based on the circumstances. What do you mean by circumstances? What products they are dealing with? What are the terms and conditions? What are the regulatory requirements? What accounting policies? Are there any new conditions or events? Now, same way, we need to verify how changes in accounting estimates they are making. Generally, an accounting estimate change is required if there is a revision in circumstance. So what do you mean by revision in circumstance? Whatever circumstances, there are changes in that. Changes in type of product, changes in terms and conditions, changes in law and regulatory framework, changes in accounting policies, changes in events and conditions, resulting of new events and conditions. What if after analyzing this, you understood there are some accounting estimates which management failed to identify. There are some accounting estimates which management failed to identify. Upon inquiring regulatory requirement, I discovered that disposing cost of the batteries after the end of life, disposing cost of the batteries at the end of the life of the car, that is the manufacturer responsibility. But company did not create provision for it. They did not create provision for it. Then I need to look into the root cause of the reason. Why they didn't create the provision? Is it because they don't understand this framework or this requirement, or is it because of the negligence of some staff, or intentionally they did? Suppose if I find there is no such evaluation within the company to evaluate the regulatory requirements. Like in order to create an accounting estimate, you need to see from where a requirement comes, we don't know. Framework may tell you, applicable framework may tell you to create an estimate. Accounting policy might tell you to create an estimate. Terms and conditions of the contract will tell you to create an estimate. Products that you're dealing with might create an estimate. But in that estimate making process, no, when I see the control document, no, company does not include regulatory requirement. The company does not include regulatory requirements or changes in regulatory requirements. They didn't include, which means it's a control deficiency. It means what? It's a control deficiency. And since this control deficiency is impacting a large item in the financial statement, it's called as a significant deficiency. What is it called as? Significant deficiency. They'll give you an MCQ on this. Management failed to identify an accounting estimate. What should be the auditor's response? Auditor will modify the opinion. Auditor will report to those charged with governance. Option B, auditor will consider that as a significant deficiency in internal control. Auditor has to evaluate whether whether failure to identify constitute significant deficiency. So the standard says determine whether there is a significant deficiency regarding entity's risk assessment process. Clear? Then okay, I understood. I did risk assessment where and all in this entity estimates is required, and I also verified how management is making estimates. I mean, in the sense how management is identifying estimates. Sorry, how management identifies the estimate is this answer. How management is making estimates, that is a different answer. How are they identifying? How we identify whether an accounting estimate is required or not? Look at the products you deal with. Look at the terms you are offering. Look at the accounting policies. Look at the framework, legal and regulatory applicable financial reporting framework. Look at any circumstances, events, transactions that are newly arising. Yes or no? If they fail to identify, is the failure because of the control weakness? Determine that. If at all it is a control weakness, significant deficiency, communicate it to those charged with governance. That is what 265 says, and follow up whether they remedified or not. Yes or no? Now, having understood how the company identifies estimates. Okay, they identified decently, covering all the areas that requires an estimate. They're covering all the areas. Now, how are they making it? Now you need to understand how are they making it, what method they are using, what model they are using, what controls they implemented, whether expert has been used or not, what assumptions they are using, are there any changes in methods for making these estimates, whether management has considered estimation uncertainty, while making the estimate. And auditor shall review the outcome of accounting estimate. Auditor shall review outcome of the accounting estimate that is made in prior period. Further, see how management is making estimate means, if at all estimate is made during the current year of audit, you verify what method they are following, what model they are following, what assumptions they are using, whether they are using an expert or not, are there any changes in these particular methods and all. I evaluate all this, and I will also see whether estimation uncertainty considered or not. I will see. Definitely estimate is not an accurate, some uncertainty will be there. Whether uncertainty is considered or not, I will see. In addition to that, some estimates, no, they just brought forward it from prior period. And they are using it. They are using it the same estimate. They are continuing in the current year also. Whether re-estimation required or not, you need to check. Correct? Prior period decommissioning liability they recognized. At that time, whatever the liability is recognized, it is dependent upon the data available at that time. Now the data might have been changed, circumstances might have been changed, assumptions might have been changed. So re-estimating the brought forwarded estimates, nothing but. In this, on this, there is a previous year question on this, which is given in the ICA book itself. Here the company said, auditor want to verify whether re-estimation is required for an accounting estimate made in the prior period. So auditor is asking data from the company regarding prior period estimates. Management said, you are doing current year audit only, prior period audit, why it is relevant for you? Auditor for that, no, he is replying, look, I have a standard 540. As per that standard, the auditor shall review the estimates that were made in the prior period. I need to review that estimates, and if required, whether re-estimation is required for the current period or not, I have a duty to review. So you cannot deny me. Moreover, I need to tell them, look, this is an estimate only. Outcome will be real outcome will be different. So this is an estimation. The actual outcome might be really different. I want to know, so like for some estimates, in the last year, there would have been actual outcome this year, right? The real outcome would have been there, right? Like in the sense, in this year, a transaction would have materialized, right? For example, I created warranty provision in the last year. This year, warranty expenditure incurred is substantially higher amount. I need to look into previous period estimates to judge quality of estimate making process. I want to judge quality of estimate making process. How are you estimating it? See, current year estimate, I understand. How are you estimating it? Previous year estimates, have you estimated reasonably? Current year, some actual transactions will give the evidence for that. Current year audit procedures will give evidence for previous period estimates. Like auditor will consider effectiveness of management's prior period estimation process, from which auditor can judge likely effectiveness of current period estimate. I want prior period estimate data to understand how logically, reasonably, realistically you are making estimate. So that estimate, it would have resulted into some actual settlement this year, right? Both I will compare. That will give me an idea whether your estimate making process is genuine or not. So that is the reason why I want to review prior period estimate. Further, whether I will also get information regarding whether re-estimation is required or not. Because last year you have used some data for making an estimate. Same estimate you are continuing. Is there any changes in the data? I want to see that. So audit evidence, like I also get what? Estimation uncertainty. I also get information about estimation uncertainty, whether it is properly disclosed or not also I want to see. So therefore management is not correct refusing the auditor. Management is not correct in refusing the auditor. By the way, we are reviewing prior period estimate. Is it with an intention to judge, or is it with an intention to question management process? No. We want to see how effective it is, so that current year process effective or not, I will get an idea. I am verifying prior period data to understand whether re-estimation is required or not. For that reason I am taking. It's not to identify prior period item. It's not to identify an error or omission in the prior period. No, that is not the purpose. Clear? All of you. This itself can be asked as a question, and it was asked. Many times it was asked. Auditor is asking prior period data. Getting it? And management is denying. Fine. Then suppose how management is making estimate, one of the point you need to verify is what? Is estimation uncertainty considered or not? Suppose estimation uncertainty is there. Estimation uncertainty is there, and that too the estimation uncertainty is very high. The auditor has classified the estimation uncertainty as significant risk. The auditor has classified it as significant risk. Then what auditor shall evaluate? Auditor shall evaluate whether management has performed sensitivity analysis. Sensitivity analysis. Whether management has performed, I think in AFM you have this word. Sensitivity analysis. What is sensitivity analysis? Changes in factors leads to changes in the actual outcome, actual estimate. So whether management has considered alternative assumptions, why they rejected them, how present estimate is addressing the uncertainty, whatever present estimate you did know, how is this evidencing uncertainty? Significant assumptions, are they reasonable? Whether applicable framework related has been properly applied or not. Whenever an estimate involves high estimation uncertainty, once again check whether are there alternative assumptions possible, why they rejected so many other options, why they selected this option, whether applicable framework is correctly applied, whether significant assumptions chosen are they reasonable, genuine. You need to verify that. Suppose if estimation uncertainty is not answered, management did not answer, they did not conducted any sensitivity analysis, nothing, no workings, then you have to develop a range. The auditor has to develop a range. Means auditor will design, auditor based on the data available, auditor will develop the estimate and see the reasonableness of the management's estimate. He will evaluate the management estimate. Like what is auditor's range? What is auditor's range? Very simple. Auditor's point of estimate or auditor's range is nothing but it's an amount, range of amount derived from audit evidence for use by auditor to evaluate management's estimate. Management has estimated something which involves high uncertainty, which they didn't address. To verify whether it is reasonable or not, I will develop an accounting estimate and I will verify the management estimate. This auditor's range will be developed when When there is an estimation uncertainty giving rise to significant risk, management has not addressed it. That time only we will develop our range. Correct? They'll give you MCQ like this. What will you answer? Under what circumstances auditor will develop an auditor's range or auditor's point of estimate? When auditor will develop this? What will you write? This answer. When management failed to address estimation uncertainty. Getting it? Next. Then we will have to do, we have to verify recognition and measurement criteria. We have to verify recognition and measurement criteria. Like here we will verify very simple. We will verify whether applicable financial reporting framework, whether the applicable financial reporting framework has been properly applied, whether management decision to recognize or not recognize. Like some cases, they may recognize an estimate. In some cases, they don't recognize at all. It doesn't require. Is it okay under framework? You should check. And whatever management basis is there, like basis means nothing but the data, how the management is making estimate, check that. Specifically what I will check, I will test check the data used by management. I will evaluate whether methods used, assumptions made, are they proper in the circumstances? Whatever methods they are using, whatever models they are using, whatever data they are using, are they proper? Suppose the accounting estimate is based on some data, whether the data is accurate, whether the underlying data is complete, whether the underlying data is relevant for this entity. Sometimes they use external data. For example, insurance companies, while calculating provision for actuarial liabilities, they use market data. Whether that data, what is the source, what is the relevance, what is the reliability, and recalculate the estimate, whatever they made, right? You apply recalculation, whether the computations are right or not. Test check the controls, look at the internal controls. These are all nothing but what? Further audit procedures. These are all nothing but what? Further audit procedure. In this is compliance procedure. This is substantive procedure. This is compliance procedure. Test check the effectiveness of controls. That is compliance procedure. Testing the data, verifying external data, whether recalculating. These are all substantive procedures. Auditor will evaluate the methods, right? That is also a substantive procedure. Test check the data. That is also substantive procedure. Not only that, identify is there any subsequent evidence available. As on 31st March, they created some provision for some electric cars, some amount. But you are doing audit report, you are preparing audit report somewhere by July mid. 3.5 months gap is there. Within this 3.5 months, what are the claims were lodged with the company for warranty purpose? See how much claims they lodged and how much is the condition provision they created per car. You can calculate. See whether the provision is reasonable or not. Subsequent conditions, if at all they indicate that provision is underestimated, you ask the company to revise. Subsequent evidence also you have to verify. Up to which date? Up to auditor's report. Even succouring up to the date of auditor's report. Subsequent evidence also you should verify. This is substantive procedure to verify accounting. Or this I can call it as, this is nothing but response to the auditors. Response to the risk assessed. So whatever the risk you assess, now how do you respond? You are getting the point. Now you recollect the standard structure. First, you do identify, you first do risk assessment of how the entity is identifying estimates. What are all the estimates that the entity did not address? How are they making the estimates? And is estimation uncertainty addressed by them or not? And now you need to verify recognition measurement in books of accounts by actually performing the audit procedure. Thereby you will understand whether the estimate made is ultimately reasonable or not. Finally, evaluate the reasonableness. Evaluate the reasonableness in the context of applicable framework. Are you clear? Finally, reporting and disclosure. What is the reporting and disclosure? I shall obtain sufficient appropriate evidence whether accounting estimates, getting it, they are all made in accordance with the requirement of the applicable framework. And specifically, estimation uncertainty related to significant risk, you must disclose it. You must disclose estimation uncertainty related significant risk and get a written representation that significant assumptions used in making estimates are reasonable. Whatever significant estimates they are making on assumptions, they are reasonable. You can also get representation for some other, whether data used by the management is complete, accurate. You can ask a representation whether assumptions used are reasonable or not. You can ask a representation whether controls implemented are sufficient or not. You can ask a representation whether controls are operating effectively or not. Are you clear? All of you? Finally, you need to document. What you need to document? What is the conclusion regarding reasonableness? And is there any management bias? For example, I will show you this Tata Motors. We'll see Tata Motors estimation uncertainty. Yes, you see here, estimation uncertainty is considered as a key audit matter. Remember, key audit matter, one of the factor is what? Significant assumptions, significant estimates, significant judgments. Yes or no? That is one of the factor. So they selected it as a key audit matter. So what they evaluated under Ind AS 109 financial instrument, where you need to provide elements for loan losses determined using expected credit loss estimation model. Means they are using accounting standard applicable financial reporting framework model. You have this in syllabus? Yes, sir. The estimation of expected credit loss involves significant judgments and estimates. The key areas where auditors will judge, will verify. First they verify the data, then they verify the model, then whether any adjustments, qualitative adjustments are required. Next, that's it. These are all the points that were involved. So what auditor verified? Auditor verified first operating effectiveness. Auditor verified controls over it. Auditor verified controls over application of the criteria. Then auditor verified some management's calculations, all that. Yes or no? Then the auditor verified controls. The auditor verified operations over technology. Like various details he verified. This is a separate matter, I think. Yeah, this one. So the same points, whatever we have seen here, the similar points only covered. Like here they are talking about really what controls are verified, all that. Next, like regarding this, there will be a disclosure requirement also. This is a notes to account. This is notes to account, usage of estimates and judgments. Like you see, in particular information about significant areas of estimation uncertainty, they are given some notes. Like what are they? Impairment of goodwill, PPE, recoverability of deferred tax, provision for product warranty, asset obligations, employee benefits, financial receivables, discounts paid to dealers, something, going concern assessment. These are all estimates only. These are all estimates only. So you will find disclosures for estimation uncertainty in these financial statements. That's it. The standard is over. Easy. Hardly 40 minutes we spent. Understood?